Hey everybody, so I wanted to make this video for you and I happen to think it's a good one. So today we're going to talk about book value per share. So what is book value per share? Well, the formula is assets minus liabilities, which is actually net assets, divided by shares outstanding. Now if you know a little bit of accounting, you'll know that liabilities plus equity is equal to assets. So assets minus liability is actually equal to equity. So if we wanted to do a short version of this formula, we would just do equity divided by shares outstanding. And then we could get book value per share. But for the purpose of making it easy to understand, I'm just going to keep this formula as assets minus liabilities divided by shares outstanding. And in this formula, we're talking total assets and total liabilities. So there's a few points that I want to go over. What happens to the balance sheet when a company does a share offering? Well, when a company does a share offering, what happens is that equity will go up and assets will go up. Liabilities are not affected. So when we're looking at this equation right here, equity goes up, assets go up, and they go up in the same proportion. Therefore, this equation still holds true. Liability is nothing's going on with liabilities here. So here's the problem that people make. So people will make the mistake of comparing book value, which is assets minus liabilities, to market cap, but they don't consider what I just said. Because if a company is constantly doing share offerings, well, what's going to happen is that their assets are going to go up. And it's going to look like they're a pretty cheap company. But what's also happening is that their shares outstanding are going up too. So what we do to counteract this is we do this equation right here. We divide by shares outstanding, and that takes into consideration of companies doing offerings. So let's actually take a look at some examples. So for example, and by the way, all of these numbers are in thousands. So when we're looking at Rivian, their total assets was this amount. That was their total liabilities. That was their shares outstanding. So what I do is total assets minus total liabilities divided by shares outstanding. And what we get is book value per share of 21.68. Rivian is trading at about 30, I believe. So it's trading above book value. Now let's look at Nano Dimension. I mean, this one was like Kathy Wood's favorite. I don't know if it still is, but I do happen to think that at these prices, it's actually not a bad gambit. So we're going to look at the total assets minus the total liabilities divided by the shares outstanding, and book value per share is actually $5.22. Right now, this stock is trading under $3, so it's actually pretty darn cheap. Now, we could do something cool. We could look at GameStop, and we could look at their total assets and their total liabilities at a certain point of time. So now I'm going to pull up Webull. And believe it or not, GameStop actually traded at $2.57 at one point. This was at April of 2020. So what I'm doing here is I'm going on the balance sheet and I'm looking at the date that is closest to April of 2020, which is this right here. And I'm grabbing the total assets right here. I'm grabbing the total liabilities right here. And I'm grabbing the shares right here. So then when we actually do this calculation, which I'm going to show you right here, we are doing assets minus liabilities divided by shares outstanding. And we see that when GameStop was trading at that price, the $2.57, its book value per share was actually $9.51. So, gosh, I mean, let's just divide this. Let's see how many times. So yeah, it was trading, so book value was actually 3.7 times its market cap. So this is a solid reason why people would have been investing in GameStop at $2.57. It's because it was dirt cheap and it was trading 3.7 times underneath the book value of the company. So this is why this concept is important, you guys, because let's say that you own a certain SPAC company and it is just getting murdered and it is getting driven to the ground. There is a complete chance that it could actually be trading underneath book value, and you wouldn't even know that, and you would just sell it because you want to get rid of the pain and you're sick of seeing the stock consistently fall. But you would have been making a big mistake because you would have been selling significantly under the book value. But there is also another consideration that you have to make. A lot of these companies lose money. So that means that their assets are going to continue to fall. So you have to forecast what cash burn will look like. And that should be taken into consideration when you're looking at book value per share. So what you actually want to do is you would want to go to the statement of cash flows, and you would want to look at their operating cash flow and see how much is actually going out, so you could get some sort of idea of what they're spending every quarter and what that looks like in 1 year's time. So I hope that this video was very helpful to you guys, and I hope you guys have a good one.